So the steps that are involved is we have to break down land bank of the company into various verticals like residential, commercial, real estate, retail, and also the ongoing projects of the company and establish the development profile, like the number of years to develop an annual development rate for each micro market and vertical. Then we have to estimate the average realization per square feet or the rentals per square feet for all the verticals and micro markets based on company's guidance, channel checks, market reports published by property consultants or by your own research. The growth trend is projected on the basis of the demand-supply dynamics pertaining to each vertical. So the growth rate in the development depends on two factors. First is the execution rate and the demand in that particular micro market. So once this is done, we forecast the cash flows from each of these projects, which is based on the kind of execution, the kind of absorption of the residential or commercial properties, and the lease rentals if any of the properties are on lease, which are, after getting the cash flows, we discount it back or capitalize based on the discount rate and the capitalization rate assumptions. This gives us the NAV for the land bank. Now, after arriving at the NAV, we give a premium or discount to the NAV based on, which is more a subjective analysis, which is directed by factors such as the quality of the land bank, the quality of execution of the company, and the financial strength of the developer. So taking all these factors into account, we give a premium or a discount to the NAV that has been calculated in our, by taking on various assumptions of, the growth forecast that we have assumed and the kind of execution that we have assumed for all the property, the lease rentals that we have assumed. After applying all these assumptions, whatever NAV has been derived, we give a premium or discount to arrive at the value of that particular company. So what are the key drivers? Around 5.5%, and it is expected to grow over the next upcoming period, and it definitely bodes well for the residential real estate segment. Vital role for driving demand in the real estate, basically the real estate, residential real estate demand basically. So the demographics in India is very favorable and is biased towards residential segment. About 65% of the population is in between the age of 18 to 35, which which no other country has at present, and uh, the demand is definitely there. The latent demand is definitely there, and urbanization cities. We are hearing the concepts of smart cities getting implemented in India over the next decade or so. So I think both demographics and urbanization is favorable for the growth in the residential segment in India. Next is the fiscal incentive and the interest rate environment. We have seen recent rate curve trending downwards only, since we have the market has peaked in terms of interest rates, and there's a lot of push given by the government for owning a home, and there's a lot of fiscal incentives or tax incentives also, which bodes well for the residential real estate investments. Coming to commercial real estate, there are two major drivers, which is the IT/ITES growth, which India has been witnessing over the last couple of decades, and the organized retail and the hospitality demand, which drives the demand for retail and hospitality segments. So the IT/ITES sector is around 50% over the last 6-7 years, which also indirectly contribute to the residential demand as well. So if we try to understand, what is the contribution of ITIS, ITITAS is basically IT-enabled services, vis-a-vis the retail and hospitality segment. What is the breakup of uh, between these two segments within commercial real estate? So ITES comprises about 75% of the commercial space under construction, whereas the rest is dominated by retail and hospitality segment. So within retail hospitality also, organized retail penetration level in India is at around 4.5%, which is lowest compared to other emerging markets. And economic growth and changing demographics also drives the retail penetration levels. Whereas strong tourist arrivals would spur the demand for hotels in India. Foreign tourist inflow is also about 20, has witnessed about a growth of around 20% in the last 5-6 years. And there's a huge shortage of rooms, hotel rooms in India. About 150,000 hotel rooms are approximately available in India, and the requirement is for about 2 lakhs or 2.5 lakhs more rooms. So for a developer, what are the various indicators for when we are choosing to invest in a real estate company? So what are the parameters that we should look at? Ideally, a debt equity ratio of 1:1 would be reasonable. And the key parameters to determine the execution strength of a developer is the asset turnover ratio, the annual square feet, or the execution rate delivered over the past few years, and the kind of backward integration they have. One example in point is the sugar developers, which is an excellent example of backward integration when it comes to real estate. Now, initial sourcing of raw material, investment in high-end eco strength of a particular company. So based on all these parameters, we can give a premium or discount to a particular developer when we are trying to invest directly into a real estate company. So to sum it up, I mean, the positive indicators for the real estate industry as a whole is lowering of interest rates, reduction in new launches, which matches the supply with the demand, relaxation in FDI, tax breaks for residential investors and developers, and increasing the tax offs for individuals who are buying the houses for the first time, introduction of real estate investment trust, and the relaxation in RBI norms given to, or RBI lending given to the developers.